What is the single biggest fear that paralyzes new investors? It's not picking the wrong stock. It's not even losing money. It's the fear of investing at the exact wrong time. The fear of putting your hard-earned savings into the market right before it crashes. So you wait. You watch the news. You try to find the perfect moment to buy in. But what if I told you that trying to time the market is a loser's game? And what if I told you there's a simple, automatic strategy that not only removes this fear, but is mathematically proven to be one of the most effective ways to build wealth over the long term? This strategy is called dollar-cost averaging, and it is the key to investing with confidence, no matter what the market is doing. So, what exactly is dollar-cost averaging? Let's forget the jargon. The concept is incredibly simple. It means investing a fixed amount of money on a fixed schedule, no matter what. Whether the market is soaring to all-time highs or crashing in a panic, you buy. Every week, or every 2 weeks, or every month, you invest the same amount. Like clockwork. Think of it like buying groceries. You don't try to time the market for when the price of eggs will be lowest. You just go to the store every week and buy what you need. Sometimes eggs are more expensive, sometimes they're on sale. Over the course of a year, your price averages out. Dollar-cost averaging applies that same simple, powerful logic to your investments. To see why this is so effective, let's tell the story of two investors, market timing Mike and consistent Chloe. Both Mike and Chloe have $12,000 to invest in an S&P 500 ETF over the course of 1 year. Mike is a market timer. He's smart, he reads the headlines, and he wants to invest his $12,000 in one lump sum at the absolute perfect bottom of the market. Chloe, on the other hand, decides to use dollar-cost averaging. She sets up an automatic investment of $1,000 on the first day of every month for 12 months. Let's imagine a volatile year for the market. In January, the price of their ETF is $100 per share. Chloe invests her first $1,000 and gets 10 shares. Mike waits. He thinks the market is too high. In February, the market dips to $90. Chloe's automatic $1,000 investment now buys her 11.1 shares. Mike is tempted, but he thinks it might go even lower. He holds his cash. In March, the market panics and crashes to $60 per share. Chloe's $1,000 now buys her a whopping 16.7 shares. She's buying on a massive discount, automatically. Mike is terrified. The news is screaming recession. He's too scared to invest. He waits for things to calm down. Over the next few months, the market slowly recovers. Chloe keeps buying $1,000 at a time at $70, $80, and $95. Finally, in December, the market is back to $110. Mike sees the strong recovery and feels confident. He invests his entire $12,000 lump sum, getting 109 shares. He feels pretty good. But what about Chloe? Over the year, she also invested a total of $12,000. Because she bought shares every month, her average price per share isn't $100 or $110. Her average cost is around $85 per share. This means her $12,000 bought her over 141 shares. Even though Mike tried his best to be smart. Consistent, Chloe ended up with significantly more shares for the exact same amount of money invested. She never once looked at a chart. She never read a headline. She just put her plan on autopilot and won. This story reveals the two pillars of why dollar-cost averaging is so powerful. The first pillar is the mathematical advantage. When the price of an asset is high, your fixed dollar amount automatically buys you fewer shares. When the price is low, that same dollar amount automatically buys you more shares. This process naturally lowers your average cost per share over time. You are automatically programmed to buy more when things are on sale, which is the exact opposite of what our emotional instincts tell us to do. And that brings us to the second, and arguably more important, pillar, the psychological advantage. Dollar-cost averaging is the ultimate antidote to the two emotions that destroy investor returns: fear and greed. Greed makes you want to dump all your money in at the top, when everyone is euphoric. Fear makes you want to sell everything at the bottom, when everyone is panicking. It also defeats a third silent portfolio killer: analysis paralysis. This is the state of being so overwhelmed by charts, news, and opinions that you do nothing at all. You spend weeks researching, but you never actually invest because you're afraid of making a mistake. DCA is the antidote. It replaces endless thinking with simple, consistent action. The system does the work, so you don't have to. It creates a simple, rules-based system that removes emotion from the equation. It turns investing from a stressful guessing game into a calm, boring, and incredibly effective habit. So, how do you actually do this? It's the easiest thing in the world. Step 1. Log into your brokerage account. Step 2. Find the Recurring Investments or Automatic Investing section. Step 3. Choose the ETF you want to buy, like VTI, from our 3-fund portfolio. Step 4. Enter the amount of money you want to invest. It can be as little as $5. Step 5. Choose the frequency. I recommend weekly or bi-weekly to match your paycheck. That's it. You set it up once, and your wealth-building machine is now running on autopilot. You are now automatically buying assets, building your portfolio, and taking advantage of market dips without ever having to think about it. So, should you ever invest a lump sum? If you receive a large amount of money, like an inheritance or a bonus, studies show that investing it all at once, or lump sum investing, has historically produced a slightly better return. And it's important to understand why. The stock market, over the long term, goes up more often than it goes down. So, mathematically, the sooner you can get your money into the market, the better your odds are. But that statistic exists in a spreadsheet, not in the real world of human emotion. That data comes with a massive emotional risk. If you invest it all and the market crashes the next day, would you have the stomach to stick with it? This is a concept called regret minimization. With a lump sum investment, you risk the catastrophic regret of investing everything right before a 50% crash. That kind of regret can scare someone out of the market for a decade, completely destroying their financial future. With dollar cost averaging, you completely eliminate that risk. If the market crashes after your first investment, you feel smart because your next purchase is on a discount. For most people, the peace of mind that comes from dollar cost averaging is far more valuable than a slight potential increase in returns. The most important takeaway is this: the best time to invest was 20 years ago. The second best time is today. But the best way to invest is consistently, over a long period of time, without trying to be a hero. Dollar cost averaging is the tool that allows you to do that. It's the simple, powerful strategy that turns market volatility from something to fear into an opportunity to be embraced. If this video helped you conquer your fear of investing, please hit that like button. It's the best way to support the channel. And make sure you are subscribed so you don't miss our next video. My question for you today is, what is the biggest fear that has held you back from investing? Be honest and drop it in the comments below. Let's talk about it. Thanks for watching, and I'll see you in the next one.